Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next, let's say, 20 minutes here on Options Guy TV. UNH, the trade that we set up before the weekend, is working out just fine. It's doing what it should do, which is go up a little bit and drift towards the middle strike of our open wing butterfly. I've kind of have a new love for UNH, and we mentioned it more than once that Berkshire Hathaway and their portfolio decided to buy about $1.6 billion worth of it. The company has a lot of insider trading, CEOs, and buying them at higher prices than where the stock is currently at, but obviously been in the news, added some volatility. Stock used to trade like a utility. The vols have came off a little bit, which doesn't make it quite as exciting. But I like the fact that it's a $300 stock. And a little bit, higher price stocks allows you to get a little bit wider on your spread, get a little bit rewarded for it. And so let's start by looking at the UNH trade. And then I want to run and talk a little bit about Starbucks. Now, I was meaning to talk about Starbucks last week. I'm not 100% sure if I did. I'm putting up a lot of content across a lot of different platforms. But if not, it definitely made a breakdown today. So I want to look at a couple of trades in Starbucks to finish off the show. But right now, I like what's happening in the UNH trade. If we look at this, I'm peeking over here at my screen grab from last week. Oh, I guess I'm not peeking over there anymore at it. Let's go and pull this back. Sometimes that does happen on the MacBook, I gotta admit. And we did this trade. Give me a second here. I'll find it and then I'll come back. $5.30. So we're up about 60 cents on the trade today. And let me pull up the Tradier Pro once again. Okay, we're back. And right now on the UNH trade, we're seeing time decay really start to kick in. So when we right now UNH, it jumped a little bit. That's also very helpful. So this is exactly what you want to happen in the butterfly. You want the market to stay below this strike and slowly make its way up. On the open wing butterfly, though, it's okay if it blows through it because of the fact that we are profitable on the upside on the trade. We always usually do them a little bit shorter term. And that's part of the reason why I like to use them as the trade on Options Guy TV, because we can talk about it from show to show. It's not a long, boring trade, which I'm actually going to show you in Starbucks here in a little bit, that lasts forever and takes forever to play out, which is more of a normal trade that I may do inside my portfolio. But I do like the UNH butterflies, and everyone that we've done so far has been well at, it's always dependent on when you get out of the trade, but they've worked out pretty well. Let's just leave it right there. Okay, right now the stock is trading at 318.85, so it has jumped a little bit since I started prepping for the show. It's up $3.44 on the day, or 1%. And the marketplace is, I don't know, choppy, I guess. We still got the VIX down around 15. We got the S&P 500 index up just a little bit today, about 0.25%, or right around 16 points. So UNH being up 1%, leading the way in the market, and that's a good thing overall. So let's go and look at the trade. Here we looked to do the September 12th expiration. We bought the 310 strike, sold 2 of the 325s, and bought 1 of the 330s. Now, we set this up on Friday. We paid $5.30 approximately on that. And if you look at the movement on this, now it's trading for $7. So if we do hit this short strike and we are up $2 or $3 on the trade, we want to get out of the trade. The maximum it can trade for is $15 all the way up at the end. And you see over here, now this is based off of today's prices, but this is where your profit and loss is at. But it's $15 minus this $7 that it's trading for right now. I wouldn't want to get out of the trade right now because the momentum is going to the upside. If we get all the way up and we blow through our high strike at the 330 strike, from that point on up, this does have the ability to trade for $1,000. We put it on for right around 530. So we did have that ability to make just a little bit shy of $500 on the trade. So right now the trade is doing exactly what we'd like it to do. Slowly start moving up towards the strike. We got a little bit of time decay. If it comes up here, here's the one thing that's really nice about the open wing is if it's hanging in this area, there's no real reason to panic and just get out and say, oh, I need to take my trade. Now, you could get blindsided by news, which has happened in UNH recently. It's part of the reason why vols have started to creep up is because news has affected the stock. And, it's not been good news. It's part of the reason why it's down so much. So with that said, you do have to worry about the gap opening. But if the market does come back and you're hanging out in this area and it lands here, well, we're closer to a home run on this trade. So solid trade, put it on, watch it. I like the way that it's working. So now we're going to look at Starbucks today. So fundamentally, Starbucks is struggling. And they've had the CEOs coming in saying we're going to revamp everything. Numbers have not been good. Still trades at a fairly high valuation. And also the economy in general. Last week's news on the jobs report showing a little bit of weakness in the economy hurts Starbucks. People don't like paying $6 for a cup of coffee. And so Starbucks has reflected that, the fact that it's a little bit overvalued. And if we look at the chart on Starbucks and we see where we're at, I just put a little bit of a support line in here right at this range. And let me zoom in on the chart. And we broke that on the downside. So now that's acting as resistance. But we see when we broke out here, we actually had the golden cross, right? The 20-day crossing over the 50-day moving average. And the stock had some strong momentum, ran up and bumped against the 200-day, couldn't really break out, couldn't establish itself to the upside, a little bit of period of consolidation. And this area was a pretty strong area of support, touched 1, 2, 3 times, and the 4th time it's finally broken down. So I do think with the economy, I think with the struggles that Starbucks has had, not to mention the fact that we got a little bit of a chart situation, I'm going to look at 2 different trades. I'm going to do one that's short term that we can talk about on the show because it will, not last that long, and we'll have something to go back and rehash in a few days. And then I'm also going to look at a longer term trade and talk about the setup of the trade and how I would look to do a short call spread to get bearish on this trade. So let's look at both of those. So let's go back to the what if calculator. I already have them loaded up. Pull this back. So the first one here is going to be the long put spread. And in the long put spread, we are the short-term speculative kind of straddling the underlying stock, hoping that the market will go down, and we're going to kind of do a 50-50 bet in this situation. We're going to go a little bit in the money and buy about as much time premium as we sell. In that scenario, usually if you're doing a 4-point wide spread, you're going to pay $2 for it. If you're doing a 6-point wide spread, you're going to pay $3 for it. It's all about the setup, how much time premium you're buying versus how much time premium you're selling. So when you straddle and you go around it, usually equidistance in and out of the money in the theoretical world is going to have about the same amount of time premium. And obviously in the real world, things kind of change. You get volatility skew mixed in, and markets are constantly moving, but that is the concept. So here is the first more speculative trade in Starbucks. We're going to send that one to the ticket. 177 right now. So I don't mind it. Where are we at? 184. We're buying the 88 strike put when that's going to be our power. That's going to be the more expensive option contract. And then we're going to sell the 85. Market's moved. So we're going to go a little bit more. That's only 3 points wide. Oh, we're going to adjust this. 88 of 85 will go. I'll try to make it a nice even number, right? So we'll go 4 points. We're 3. Let's go down one more. Let's go 87. And then we're 2 points in the money. And then we'll go 2 points out of the money. And we'll go down to 83. And we'll make this 4 points wide, approximately 247. I'd like it to be a little bit. We're too much in the money. So 84 is now the at the money. So let's go 6 here. 82. Let's go down to 80 and make this 86. Okay, now we're 6. No, okay, I don't mind that one. Let's do this one right here. Let's see what the 80's trading at on 1024. Let's send this one to the ticket, and 1024 is the expiration. We want to make this one shorter. Here we go. September 19th. 19 days away. Okay, so now we got the market at 84. We're going a little bit, and we're getting 47. Let's go back to, let's make it 5 and pull in that 65. And we'll look at the 81 and 2. All right, so here we go. I like this setup better now. Sorry, the market moved against it, as always, battling against the market moving versus having the show ready and set up to go. So now we're a couple of points in the money. We're going to buy the 86 strike call. Intrinsically, it has 95 cents. We're going to sell the 81 strike call. And obviously in that is all time premium. So you have about 30 cents worth of time premium. We want the market to go down to 81, paying $2.14 for it, or our total risk will be $214. The maximum that this can trade for is $5. So we have $3.65 worth of ups, or $2.65 worth of upside on the trade. And we'll send this one to the what if calculator. And this is all based off of the chart. This is all based off of what we're seeing in the chart, the fact that we've broken down a little bit on the trade. You toss in the fundamentals, but we're just doing a shorter term trade going out to the September 19th expiration. Now, I also like this just as a longer term bullish trade. If we look at the Options Pro trading options chains, the earnings are out in November. I want to avoid the earnings. I don't need to go that far out in time. And I'm going to also look at selling the October 46-day away short call spread. Now, to me, this is more of a setup that you might do on a standard basis. Find underlyings that you don't like, that you want to get bearish on, and we're going to sell a little bit of premium. We got some volatility and some predictability in Starbucks. It's a great underlying, I think, to sell some premium in, trading at about 30 vol, avoiding that earnings going out to the October 24th date, 46 days away. So here is, going back to the what if calculator, here is the short call vertical spread that we're going to look at. And in this instance, we're going to use that 1024 expiration date. And we're going to sell something at the money. Now, I like to get a ratio where if you got about 5 points of risk, you're going to bring in about a third of that. So a decent risk reward. And I prefer to sell something at the money and have a little bit less risk. I'm not big on um, going further out of the money and bringing in a small credit. I'm doing this because I am bearish. I do like the fact that we're trading at about a 30 vol. We don't have any earnings. I want some time decay to be on my side on a longer term basis. So here we go. 85, 86, market's at 84. That's moved down just a tad. I'm going to send that to the ticket. 180, 182. I like that number. All right. So if we're looking at bringing in $1.82 divided by 5 points wide, that's 0.64, 0.36. So exactly the premium that we're looking for, at least getting a third of the risk on the trade. And this is a longer term trade. We'll put this one, we'll take the screenshot, we'll put it in, we'll come back and we'll review the trade. In particular, when we start looking at the long put spread in Starbucks overall. All right, so let's just send this over to the chains, and now let's go look at the chains in Starbucks. So market's at 84. We're going to sell the 85 strike, buy the 90 strike. Looking at $1, we're going to call it $1.80. I think we could get, that's where I would want to work it at. You might want to adjust it at that point in time. And the maximum upside that we can get is going to be that $1.80, and the maximum downside will be $3.20. If the market, if I'm losing the maximum, if I see this thing trading close to 360 in this instance, I'm going to close it out. I don't want to have the trade go against me too much. I don't want to lose the maximum on the trade. So usually double what you could make on the trade, we would look to close the trade out. And then on the downside, if the market does continue on down and you are profitable on the trade, obviously I always like to close out the trades anytime that you can get about 80% of the net credit that is received on the trade. I always think about closing it out and look at where you're at relative on the charts and where you're at with your outlook on Starbucks. All right. Well, any questions? If you have any questions or comments, please do put them in the chat box. And I see Andrew is in the chat box. Hey, Andrew, how you doing? Nice. Thanks for stopping in. Well, we're doing a little. It's September and October, Andrew. So I'm going to lean a little bit bearish with UNC. I mean, I guess my outlook would be on UNC that we're trying to catch a falling knife. Warren Buffett wanted to come in and buy some of it, and that was enough for me to look at doing some trades. And I do like the fact that it's a $380 stock. It makes it a little bit easier to set up the strike. So getting a little bit bullish on the falling knife scenario, and then just don't really like Starbucks overall. I guess that sums everything up. So that's it for today's episode. I don't see any more comments of Options Guy TV. We'll be back on Wednesday, 11 a.m. Eastern time for the next edition of Options Guy TV. If you haven't taken the time to go set up your profile inside the Tradier Hub, please do that. You'll have access to all the different great speakers that Tradier has put together. So it's 100% free to do. You don't even have to have a Tradier account if you don't want to. All this is access to you, and we'll see you this Wednesday at 11 a.m. Eastern time inside the Hub. Hope to see you in the Hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.